Hey, everybody. We recently saw Berkshire Hathaway's latest earnings, and a trend that we've seen recently has continued in terms of stock sales. Not only is Berkshire selling tons of Apple stock, but what was its second biggest position, Bank of America, continues to be unloaded. We actually don't know where the position stands now because the position was about 13% stake of Bank of America. Now it's fallen below that 10% threshold, and Buffett doesn't have to report it every time he makes a sale anymore. So for all we know, he could have sold even more since the end of the third quarter. Um, so before we dive in on bank stocks, please take a minute and check out the link you see on your screen, fool.com/Frankel. You can get the top 10 stocks to buy from the Motley Fool right now. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So Tyler's joining me. As I mentioned, Buffett has been selling Bank of America, which is still one of my favorite bank stocks, in full disclosure. It's my largest bank stock investment in my portfolio. I don't plan on changing that. I don't recommend you hit the buy or sell button based on what a billionaire does alone without doing your own research. So, having said all that, we don't know why Buffett has been selling Bank of America. If it's a banking specific thing, I'm inclined to believe that it's not, just because it kind of coincides when he's selling the number one and two positions in his portfolio simultaneously. They're not both in the same industry. And with Apple, he's made it clear that it's more of a tax planning move. His general thesis is that at some point they're going to have to raise the capital gains tax to combat deficits in the US. And so he'd rather, Apple was he had something like $100 million profit on Apple. I think it was even more than that. Decided to lock in some of his gains now at today's capital gains rates. We don't know if it's the same reason as with Bank of America. He has praised Bank of America's management recently, even after the 2023 banking turmoil. He went on stage at the Berkshire Hathaway annual meeting and pretty much said that he likes Bank of America, even in that environment, and likes it better than other banks. And he put his money where his mouth is. He sold out of bank stocks like JP Morgan Chase, Goldman Sachs, a bunch of others in recent years, and did not sell Bank of America until recently. So that's kind of what leads me to believe that this is a more, not necessarily a pure tax planning move, but just a general, like, raise the capital, wait and see move, as opposed to him souring on Bank of America. Having said that, there are some other interesting opportunities in the banking sector right now. If you're too exposed to Bank of America, which could be definitely the case, really the only reason I could see myself selling Bank of America is more of a reallocation move if it was too much of my portfolio. But Tyler is joining me. He knows some really interesting bank stocks pretty well. I'm more of a big, well-known stock type of guy. Tyler's really the, you know, let's really dig deep down into the list and find one.
Turn over
Uh,
stones, Matt. Turn over stones.
yeah, nothing wrong with that. I mean, I wish I was better at that part of the research process. But I know you have one that has not been a bank for too long, right?
No, I mean, it's been around for a long time. We know it as a government service entity, but it bought a bank charter, and it's Sally Mae, or SLM Corporation, depending on how you want to call it. But for me, it's a very interesting bank, or whatever you want to call it, because over the past several years, this is a business that has, it basically originates and backstops student loans. Kind of exists in that Fannie Mae, Freddie Mac. Student loans are backed by the government in some sort of way, such that the private lenders will get paid in the event of defaults, but student loans can't be discharged in bankruptcy as easily as other things. So it's this really interesting sort of business where it's like, well, it has net interest margins of a business that you would expect to have very high delinquency rates and very, like, people not paying back their loans, but they can't discharge loans in bankruptcy. So these are eventually going to get paid out in some way or another. As of the most recent quarter, Sally Mae had a net interest margin of 5%, which, compared to large banks is quite high. I think typically for most large banks, you're somewhere in the 3 to 3.5% range. So we're looking at pretty solid profitability. This past quarter, because of accounting rules, they had to have pretty large charge-off rates, which again, this is kind of a wonky financing because according to GAAP accounting rules, they had to do this, but the actual mechanics of student loans is a little bit different. I know I'm getting really deep into the weeds here. I'm sorry, but it's one of those funky businesses where you kind of have to understand what exactly you're buying. What is kind of fascinating to me is this was a business for the longest time. It's like, well, we're going to originate student loans and then they're just going to get paid back over time and we're just going to sit on the balance sheet. But past 5 years or so, basically, they started going, well, why do we have to hold all of these all the time? These are pretty good loans that we could, turn into securities and then sell to investors. And that's what they started doing and doing this very large balance sheet management sort of thing and started selling off loans as bundled securities. And as a result, kind of really trimmed down the balance sheet and used all of it to buy back stock. I think over the past 5 years, they've repurchased more than half of shares outstanding. Is sort of a way of value creation for SLM as a business, and it's continuing to do so. It still has about $400 million left on its most recent repurchase authorization, which at a $5 billion valuation, that's like almost 10% of shares outstanding for in further buybacks. And, it's trading at 8 times earnings, which, banks can be a little bit weird. I know that typically we want to look at book value. And I think for SLM, it's a little bit higher. But again, this is a business with more secure or knowledge of that you're going to get repaid and higher interest margins. So I think there's a little bit of a valuation premium there. And I think with all of those things considered, I'm really liking the look of Sallie Mae right now. 2% dividend yield and just increased it by 18% for the upcoming quarter.
Yeah, I like that one. Being that the election just happened, I'm going to talk about one of the banks that actually performed the best after the election, but for a big reason, and that's Capital One. It's one of the more recent additions to my portfolio, and to be fair, it's actually one of the other bank stocks that Buffett owns. There are only a few of them these days, but Capital One is still one that you'll find in his portfolio. Jumped after the election results, and in my mind, the biggest reason is that pending merger with Discover. Um, it, Regardless of what you think about what side of the political aisle you're on, lower regulation is increases the likelihood that that merger will go through as planned. There's less chance that the Department of Justice is going to fight it and things like that. The Discover merger is significant for Capital One for a few reasons. Not only does it multiply the size of its already big credit card business, I believe it makes it the largest credit card issuer in the U.S. Um, there's a lot of synergy there, and I know everyone hates that word when it comes to mergers, but there's a lot of complementary products. If you think about the types of credit card products Discover has, which are generally focused on cash back, you have those rotating categories where you get 5% back in certain purchases, things like that. Capital Ones are more travel oriented in general. You get miles, you get, travel specific benefits with them. So there's a lot of complementary offerings. It's not like you'd have to combine two products into one to make it work, things like that. And more importantly, Discover has its own payment network. Capital One would be the first, I guess, mainstream bank. You can argue that American Express is one, but Capital One would really be the first mainstream bank that has like branches and everything that also owns its own payment network. Um, that's a big competitive advantage. Right now, they're paying interchange fees to Visa and MasterCard for all of their credit card and debit card products. They would plan to move the debit card business to Discover's network immediately and the credit card business more over time. That would be a big money saver. They're talking over $1 billion of annual synergies just from that. Um, Really big deal here. Um, the market, to be to put it mildly, has been kind of skeptical that the deal is going to go through. But I think the election results really make it a lot more likely. And beyond that, this is just a great business. Tyler mentioned that the average bank would be happy with, a net interest margin in the 3 to 3.5% range. Capital One's is 7.1 because of the high interest nature of the credit card business. On the other hand, that does make it more cyclical, to be fair. It makes it more susceptible to recessions and things like that than banks that specialize in mortgages and auto loans and things to that effect. But it does make for higher interest margins, um, and people are paying their bills, and it's better than expected. Capital One's credit loss provision actually declined by 1.4 billion in the third quarter. Um, the loan portfolio continues to grow, and it's actually one of the cheaper bank stocks on a price to book valuation. Trades for about 1.15 times book value as I'm recording this, and it kind of pulled back to the day after the election. And I think it is not necessarily a cheap bank stock, but it's one to definitely keep on your radar and pick up on any weakness. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.